Introducing a new era for discerning Australian investors. Brought to you by Ausbiz and backed by deep market insight, professional analysis and a proven track record. Our focus is simple: to connect you with exclusive and compelling investment opportunities. Discover what's next at ausbizcapital.com.au. This program is brought to you by LGT Crestone, local private wealth expertise backed by the stability of a global presence.
Hello and welcome to the Global View on this Friday. I'm Andrew Gagan. Good to have you with us again here at Ausbiz as we get across what happened overnight and also what to look forward to. Just getting a sense of what happened on Wall Street. The main indices there closing modestly higher while small caps slipped, and European markets closed lower for the fourth consecutive session on waning trade optimism. Now, stocks specifically, Oracle shares surged more than 13% to record highs after raising its annual forecast, fueling optimism around AI. And gold miner Newmont hit a one-week high. That's after it moved higher some 5% there, almost after gold hit a one-week high. It's now approaching that $3,400 level. Cardinal Health was also a top performer on the S&P. Now, Boeing and Albemarle were among the worst performers, with Coinbase also on the list, down more than 3%. And in relation to what we saw with Boeing there, shares of US airlines fell. That's after the Air India crash, 787 Dreamliner bound for London, falling out of the sky shortly after takeoff, killing more than 290 people. On the Nasdaq, Datadog and Constellation Energy led the pack, while Spotify, along with Tesla and Warner Brothers, had a negative session. And US listed shares of Novo Nordisk rose as it planned late-stage trials of its next-generation obesity drug, while Moderna came under pressure as it looks for partners for certain vaccine studies. And Adobe shares rose ahead of its earnings report, with analysts expecting higher revenue from strong spending on its AI-enhanced products. Well, in the US, May headline producer price inflation was cooler than expected, slowing domestic demand there, helping to restrain producer prices last month. Despite the tamer inflation readings this week, economists expecting inflationary pressures to begin building from this month. Prices for durable goods, tariff impacted, rose for the third straight month. In contrast, fruit and vegetable prices fell. And separately, initial jobs claims were slightly higher than estimates at 248,000. That's an 8-month high and consistent with labour market cooling. And the CME FedWatch tool has the probability of the Fed sitting on its hands next week at 100%, essentially unchanged from the data, or before the data was released. US Treasuries rallied in price, putting pressure on the yields. The 10-year down almost 6 basis points to below 4.35%. And the US dollar hit its lowest level of the year. In fact, its lowest since in some 3 years. It's lost around 10% of its value this year, with classic safe havens such as the yen getting a lift. And the Aussie at 65.3, and Bitcoin struggling on rising geopolitical risk. And in the UK, gross domestic product falling 0.3% in April, in keeping with the slowing global growth theme. While on the commodities front, oil settled slightly lower as traders took profits from the previous session's rally, while the US is pulling personnel from the Middle East as tensions with Iran escalate. Brent crude down marginally at $70 a barrel. Copper was higher, iron ore fell, and gold prices rising on rising geopolitical risk and on the cooler economic data. As I mentioned, they're just sitting below 3,400 US an ounce. Well, to get across what we're seeing globally and specifically in the US, Nadine caught up with Anwiti Bahuguna. She is the Chief Investment Officer of Northern Trust Asset Management, and they began by talking about the odds of a US recession amid the tariff noise.
Notice that we have actually maintained reasonably high levels of recession odds in our outlook. We're somewhere close to a coin toss in terms of where we think we might end up. And really, it's driven by the fact that despite a lot of noise around tariffs, we haven't yet reached a resolution on them. We've been sort of postponing the date of when these things will be decided by weeks and weeks. And for that fact, we have kept our recession odds reasonably high at the moment.
We do have a University of Michigan consumer sentiment read. Don't really care what you are anticipating from that. Generally speaking, though, the U.S. consumer has been pretty resilient. So when will we see this broader policy uncertainty, the geopolitical uncertainty, even the American-specific social unrest there start to really weigh in on consumer confidence?
Yes, that's an excellent question. None of that has shown up in the data yet. Indeed, we saw some reasonably good economic data in the US economy this month. We saw inflation actually continue to come down. We are seeing resilience in growth numbers, and all of these point to the fact that inflation is contained, consumers doing well. The tariff signature signs have not shown up in the data as yet.
But it sounds like you do anticipate they will. Will that be from June? And so does that mean that the US Fed is getting closer to perhaps cutting rates?
Not really. At the moment, we see the Fed on hold. There is no reason to cut rates. Growth is resilient, inflation's down, but not really at the target. And I think the Fed is really in wait and see mode to see what happens with growth numbers. If growth numbers bounce back, then there's risk that inflation comes back again. And this has meant that they are going to not rush to cut rates. Of course, it is encouraging to see this week's inflation data, and you can see there is some pressure for them to act sooner, but we don't see them actually cutting interest rates maybe until the second half of the year, perhaps at the earliest, I would say, Nadine, in September.
All right, so performance so far for U.S. equities this year continues to be driven largely by the Mag 7, in particular by the AI thematic. Is that toppy in your view? Would you still be allocating to Mag 7 names?
So we don't actually make specific name or sector recommendations, but there is a hint of that in the fact that we have not underweighted U.S. equities. We think valuations looks reasonably well pricing in the good environment that you see. We are neutral, our allocations to US equities. I think where we find interest is really more in global listed infrastructure or infrastructure plays, which in some way, Nadine, are actually a play on AI also, because they point to real assets which actually benefit from this need for extra energy that AI generates. And so that's one space that we are quite bullish on. We have a chunky 3% overweight to listed infrastructure in our portfolio allocations, and that's how we are participating in this. It's also a really good inflation hedge in my mind.
Yeah, okay. So that's a tactical preference, for global listed infrastructure at the expense of what in terms of the global market?
So we actually quite like the global markets right now. We have similarly an overweight to developed ex-US markets in the equity space. The one space where we are overweight in equities other than the tactical play is indeed in developed ex-US equities, where we think there is a lot of runway for equities to run. They're reasonably priced. Indeed, even the infrastructure names are quite reasonably priced. And those are the areas we like. We are actually underweight bonds quite heavily in our portfolios because they are at risk from this inflation risk also.
And I note that you're underweight, it looks to me at least, global listed real estate. Why is that?
So real estates are very much dependent on what happens to interest rates. They are an interest rate play, and the way markets are playing out, the way inflation fears play out is interest rates stay higher for longer, and that plays into our underweight for global listed real estate.
Okay, so Anwiti, what will really help determine your view for the remainder of the year? We're obviously in no man's land still when it comes to the ultimate outcome of tariff negotiations. I mentioned geopolitical risk rising, even if you look toward Iran, the Middle East, you've still got China-US trade tensions, the US distancing itself from really the rest of the world, including us here in Australia. They've now, reviewing a major defense agreement that we had between the two countries. So what is it that will resolve itself, or that will develop, that will help you secure your views for the remainder of the year, whatever that may be?
I think it's really good to be staying the course in your portfolios at the moment. I think that is a very interesting question. We actually debated it quite a lot in this week's investment meetings to say what would change our views. And I think it really is the fact that we haven't really seen data deteriorate so far. So if we see labor markets start crashing, or if we see a huge spike in some other part of the world through geopolitics, that may lead to changes in our view. But for the moment, it's best to stay the course in our portfolios and stay allocated to your strategic allocation.
Anwiti Bahuguna from Northern Trust Asset Management. So let's look ahead how we're likely to start just in a couple of minutes' time. SPI futures up a healthy 0.5%. And be a focus there, particularly on oil and gold stocks, given they did rise in the overnight session in the States. So hang around. We'll get across the open in just a couple of minutes.
This program was brought to you by LGT Crestone, local private wealth expertise backed by the stability of a global presence.